Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Good morning and welcome to the show. This is Andy Webb with Lifestyles Unlimited. And as always, we're working on your financial freedom. Ooh, it's a cold one out there today. I was just outside with my 4-year-old, and he was so excited. There's snow. Daddy, look at all that snow. I didn't have the heart to tell him it's a light dusting really here in the Dallas-Fort Worth area where I'm coming to you live right now. Big happy Valentine's Day to everyone out there. I guess we won't be getting out and about to the restaurants, coronavirus aside. Now we've got the wintry, weathery mix to deal with as well. And I'll tell you, I was hoping to be coming to you live from somewhere else. I was hoping to be out in the hill country this fine morning at Inks Lake State Park and a little later Dinosaur Valley State Park, but we scuttled those plans as soon as we saw what was happening on the roads, just Thursday, in fact. Instead, what was I doing? I was sitting in the RV bunker in my in-laws' driveway. Great place to be, of course, watching the Central Texas, the Lifestyles Unlimited Central Texas office presented their case study for the month. And good information there. And in particular, I was really listening and paying attention to the multifamily part of that case study, and I want to bring you some information from that case study. And in particular, there was clearly a first-time attendee asking a question, and their question was around what is the risk of losing all your money in a multifamily deal? Okay, and that's what I want to talk about, because there is a lot of fear out there for new folks, people thinking about getting started as real estate investors. And of course, losing money is one of those. Okay, so I want to talk about how we address the risk in multifamily investing, mitigating risk. Okay, that's what we did. We said, you know what, we're not getting out on those roads, tugging this giant RV behind us. We're just going to leave it here. We made the drive. Took a break when the weather was decent. Got back up to Dallas-Fort Worth. So we'll see when it warms up if I can go pick that thing up. Hopefully everything is in good shape. So we're going to talk about mitigating risk. And remember, we'll touch a little bit on Del Walmsley's rules of investing. Del Walmsley is the founder of Lifestyles Unlimited. We've been around for over 30 years now. And his number one rule is don't lose money. If you can follow that rule, that question about losing all your money is irrelevant. Right? Okay, so we'll talk about that. Talk about risk and loss. And speaking of risk as well, if you are a rental owner already, as I am, I hope you've blasted out 1, 2, maybe multiple freeze alerts to your residents. It's cold out there. Just check my hose bibs out about around the house. Make sure they're informed. Make sure they know what to do. Right? A lot of these people, especially if you're renting a single family house, people may have moved from an apartment where this was all handled for them. Perhaps maybe they don't know what to do. So quick email now may save the day for you and for them if you haven't done that already. And another PSA, let's say, public service announcement later in the show, at the end of the show, I want to share with you a new rent relief program here in Texas that starts tomorrow on February 15th. I'll give you the name of the program and tell you who can apply, how you apply, who's administering that $1.3 billion in funds to go towards past due or perhaps future rent and utilities. Okay, that can go directly to you. That can go to your resident. You determine that. But I'll talk a little bit about that program at the end of the show. And that ties in as well to the risk mitigation, I would say, and being informed as an investor. And as well a question that came up on that multifamily case study, which was around how have things been going with COVID-19 for these particular presenters. So that's the course of the show today. To open with, I want to just generally describe what a multifamily deal looks like from a document perspective so that you understand what we're reading, what we're looking at, that helps us understand the risk. Okay? So when you participate in a multifamily deal, or when you start to think about it, you're going to know the person that's putting the deal together, right? You need to have a connection there. because this is we're using a carve out that allows us to not list this as a security. So there's certain parameters that we have to meet, and one of those is a connection, right? We use a tool called a private placement memorandum to market this. It's not broadly marketed, right? It's private. So you have to have that connection. And that is, in fact, one of the documents that comes along with that package that you'll review in determining if this is a good multifamily passive, is what I'm talking about here, passive investment for you. Maybe I should clarify here. There's somebody that puts the deal together. It's commonly called a syndicator, a deal sponsor. At Lifestyles Unlimited, we use the term specifically lead investor. Okay, so that's common within Lifestyles. You may not hear that outside of the group. We call that a lead. Everybody else that gets involved is commonly called the passive investor, right? We're just putting our money into the deal, buying a portion of that apartment complex, that apartment community, essentially, and letting them run the show. And we're sitting back on cold days like today, where I don't want to be out doing anything, waiting for the money to roll into the mailbox or maybe by way of bank transfer, ACH transfer. So very hands off. And if you're trying to build a lifestyle like we are with that RV bunker when the weather cooperates, right, that's the way to go. That is absolutely the way to go. But when you start to review the deals, you're going to get a handful of documents, okay? I mentioned one already. That's commonly called the PPM, right? That's an acronym that, again, stands for Private Placement Memorandum. That's basically the marketing piece. It's going to talk about those risks. Now, and I'll briefly name a couple here in just a moment. It's going to talk about things like how did the distributions work, because that's what we're getting in this for, right, is that cash distribution back to us. That's our investment return. It's going to tell how that works. How much does the lead investor, the sponsor, get? How much do you, passive investor, get? It's going to talk about the business plan, right? That's all inside that marketing piece, that private placement memorandum. Now, if you're serious about it, then you're also going to get a company agreement or an operating agreement. That's where you're signing. That dictates how the business will actually run. So we learned about the distributions, how they're going to look like in that PPM, but the operating agreement actually lines out how that works. It tells me what my voting rights. It tells me how we can get rid of that lead investor if we don't agree with how they're performing, for example. Hey, the music's kicking in. When we come back, we'll round out this conversation around documents and talk about, at Lifestyles Unlimited, what we do to address risk as multifamily investors. Stay tuned.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. This is Andy Webb, and today we're talking about mitigating risk in multifamily investments, in particular apartments. Had a call, in fact, last week from a listener, Mike. He was asking me not so much about risk, but he was asking how fast can you get into a multifamily deal? And at the time I told him, look, the real variable, it comes down to you. We have a lot of education available on the online platform that we use at Lifestyles Unlimited. So how fast or slow do you go, right? How fast or slow do you get to that point where you're comfortable, where you've gone through all the material, you understand it, you know how to analyze the deals? Right, that comes down to you. But get this, to answer that a little more concretely, I was just perusing some of the social media the other day, and David Fisher, he's one of our life changers at Lifestyles Unlimited. He conducts the 2-day seminar, which is part of the Financial Freedom Program. Day 1, he goes into single family all day long. Day 2 is devoted to multifamily. And he had a member post on there that after going through the 2-day with David, just a month later, he's already gotten into his first apartment deal as a passive investor. So to come back to Mike's question, I mean, here's a case in point. A month, it can go again as quickly or as slowly as you want it to be. Now, my wife and I, we joined in March of 2012. We just got into our first multifamily deal last year. Sounds slow, but we've been focused on single family. We've been building that capital. So they're all different roads to Rome, and you pick which direction you're going to go. Which direction do you need to go? Do you need to build capital like we had to do? What does your course of action look like? And if you have questions like Mike did, you can give me a call here. The number is 855-497-4335. Again, 855-497-4335, or send me an email to askandy@luinc.com. And we're just taking a look in the prior segment at the documents that come along with a multifamily investment. So we're focusing on investing as passive investors here, not as the lead investor, the deal sponsor, the syndicator, the one that puts that deal together, but rather, how do we, as passive investors getting into a deal, how do we mitigate risk? Obviously, education is hugely important. We'll get to that here in just a minute. But when you first start to network with folks, with those lead investors, at some point they're going to find a good deal. They're going to put in their letter of intent. They're going to get it accepted, and they're going to start to distribute documentation. Now, you know this person, you've connected with them, you're comfortable with them. Maybe you've had a couple conversations around their longer term plans that seems to jive with yours. So they send out the documents to you. Okay, you get that private placement memorandum. Again, that's more or less marketing. That's going to tell you about the risks involved, how the distributions work, how that cash flows. Very important to us, the business plan in general. I was looking back at a PPM, private placement memorandum, that was part of a deal we got into last year. It's about 30 pages, right, plus or minus. On top of that, you're going to get a more detailed document, which is the company agreement. This one's very, very important. Company agreement, sometimes called an operating agreement. In this case, the one I looked at was about 60 pages. That's the nuts and the bolts. That's the one you need to understand all of these, but this is the one that lays out how things work. This is the contract essentially between you and that company, right? It's the agreement, the company agreement. Again, it's going to outline those distributions. Read that very well. Know how to read that. When do I get my cut? When does the lead investor get his cut? What does it look like just during the course of regular operations? What happens during a cash out refinance? What happens when we dispose or sell the asset? All very, very important. What are our voting rights, right? How often am I going to get financial reporting? And so on. Another document that comes along with that is your subscription agreement. And this is what you actually sign when you put your name onto that deal, onto that investment. It's going to ask you some questions. Who are you? Are you qualified? It may reiterate some of the risks involved. And finally, you'll have sundry addenda to these documents, a business plan, maybe some pictures of the property. Or what are we planning to do, right? Or are we going, is this a deep value play, meaning we're going to take it down to the studs and really renovate this thing? It may be a while before we have any cash flow, but here's the plan, and we're going to create a massive amount of equity on the back end. Or maybe it's a yield play. Things are running great. Maybe we can do a little bit of fine tuning, drive up the value, but we're interested in getting that cash flow in our pockets from day one. So the business plan will lay out some of that information. If you're a member at Lifestyles Unlimited, you're also going to get some analysis around the numbers. So you can see how the lead investor got to those distributions, got to those numbers. You want to understand how to evaluate that as well. Do you agree with their assumptions? Do you agree with the numbers that you're seeing in that pro forma, in that analysis that they've done of the project? And typically a PPM, this whole document set's going to be prepared by an attorney that is an SEC attorney, right? Familiar with the Securities and Exchange Commission laws. You want that, of course. And again, that PPM is going to tell you about all manner of risks. So let's talk about that. It's going to let you know, hey, that has forward-looking statements. We got out our crystal ball. How deep is the snowfall going to be today in Texas? We don't know. But in this case, we're a little bit sharper, right? We understand the business because we are educated investors, both our passives and our lead investors. But there are forward-looking statements in there. And who saw that the coronavirus pandemic was coming? Nobody in their PPM had that 2 years ago. I guarantee you that. So it will address that. It'll talk about some of the risks, operational risks, right? Real estate risks, specific to real estate, valuation, the market, other risks, tax risk. There's any manner of things. So I find that when I review a PPM from one to the next, to the next, to the next, it's fairly standard language, right? What we're doing is not... It's not rocket science. It's a very much repeatable model. So those risks are going to be the same. You learn how to read this. You read it every time. Absolutely. Because you want to make sure that language is what you expect, but it's going to call out those risks. So now let's talk about how do you address those, right? How does Lifestyles in particular address the risk that goes alongside of investing in apartments? Above all else, I would say that the Lifestyles model that we apply goes a long way towards addressing risk. Like I said, we're not getting the extreme models out there. We're kind of following that bread and butter, very consistent model that we followed for the past 30 plus years. We're focused on single family, multifamily, workforce housing, right? In apartments, we might call that Class B and Class C. If you're not familiar with apartment ratings, let's say, they're typically labeled as Class A, B, C, and D. A is that new build that's going in down the road from me here, right? They've been building any number of luxury apartments here in my area. That's a Class A. Class B is a little bit of a step down, maybe a little bit older. Maybe it's an older apartment that's been renovated, right? Commands a better rent. Class C is the next step down there. Class D is the very bottom. Maybe that's in what we call a war zone. Maybe that's a bad part of town you don't really want to go to. We're not touching that Class A. We're not touching that Class D. We're in the middle. We like to be in the middle because that's where most people are. That's where our workforce housing is. Essential workers are renting from us, renting those Class B and Class C units. So our model helps us address risk in that we're not going out to the extreme ends of, say, the bell curve. We're getting that stuff in the middle. And we buy below market. Remember, Del Walmsley's number one rule, never lose money. Do not lose money. One way we address that is simply by buying below market. If you're buying an asset at 50 cents on the dollar, you've got a lot of wiggle room. Okay, we buy below market. We're going to head into a quick break. When we come back, I'm going to pick up on other things that we address by way of the lifestyles model before talking about education and some of the operational things that we do, so stay tuned.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Back to the show. This is Andy Webb, and on today's program, we are talking about risk in multifamily investing. Participating in an apartment investment as a passive investor, handing your money over basically to that syndicator, that lead investor. What's your risk of total loss? That was a question that came up on a recent case study that I attended virtually from the comfort of my RV bunker before the snow started to fall here in Texas. And David Fisher, he was in attendance there, and he answered it very correctly. In any document you read, let me take a step back. In any of these documents that I just mentioned, it will tell you that the risk of total loss is there. They're going to tell you about a lot of different risks. Don't invest more than you can afford to lose. And that's absolutely great advice, of course. You'll hear that multiple times. But David pointed out that, look, the model that we're using at Lifestyles Unlimited, it addresses risk very well because it's a consistent model that we've followed over 30 years. So it's time-tested. We focus on a very specific niche in both single-family and multifamily, which is that, we talked about this in the prior segment, Class B and Class C housing, workforce housing. And we buy below market. So we're instantly putting an equity buffer in there that helps us absorb any issues that may come up. They don't always come up. And it's interesting, when I go to the case studies, the lead investor that's typically presenting the numbers, they'll tell you what their business plan had been. We're going to get into this deal. We're going to do X, Y, Z, improve the cash flow, improve the net operating income, drive up the value, and then do a cash out refinance in year 5, or maybe sell in year 5, take the proceeds, move on to the next deal. What I'm seeing is they're accelerating that. In fact, the deal that I looked at, the case study I saw on Thursday, they had already done a cash out refi a couple years in. They're moving much more. Their business plan is moving much faster than their conservative underwriting, is what I'm telling you here. So we're buying below market. We're underwriting the deal very conservatively. And, for more, let's call it banal, mundane things like the snowfall I'm experiencing right now in Texas, weather-related events, for example, tornadoes, maybe fire. We have insurance that covers that. There was a lead investor that did a deal, I believe it is in Indiana, and they got hit by a tornado. They had a fire. And they're still marching on and still doing very, very well with that deal. So we have insurance coverage for some of that, let's just call it more mundane sort of events. But the lifestyles model in itself is very, very key here. Okay, and if you go to any of the case studies, talk to any of the passive investors in deals, you're going to hear a lot of very positive feedback. People that are very happy with their experiences. Get on Facebook, Lifestyles Unlimited has a Facebook page. You can interact there and hear how people are doing as well. And if you're interested in learning more about that case study, let me tell you about our Financial Freedom Program. As part of that membership, you can go to those case studies. I went to the one in Central Texas virtually. Normally I go in person to the one here in North Texas. We've got those going on all over. I would encourage you to check that out. To learn more about that Financial Freedom Program, go to financialfreedomlivestream.com. You can read about the sundry benefits. There's more to it than that, but I want to focus on the case study because those are huge. Very inspirational for me as a single-family investor as well to see what others are doing right now in the market as the market changes. What do their numbers look like? Helps me keep on top of things and pivot as I need to, or in this case, shift to multifamily, take different directions. So if you go to financialfreedomlivestream.com, you can learn more about that. The membership, by the way, is heavily discounted if you use the promo code at checkout, Save Big. That gets you 2 years instead of 1 and at a massive discount. That promo code again is Save Big. So as part of our model, we go into these apartment deals. We inherently address risk by virtue of the fact that we are taking down those Class B and Class C apartments. We're buying below market. Like Dell says, never lose money. When you're buying 50, 60, 70 cents on the dollar, it's hard to do that. We've got good insurance. And then the Lifestyles Unlimited ecosystem, I like to call it, it's just a great feedback loop. And if I take the coronavirus pandemic as an example, first of all, at the very start of this whole thing, it's been almost a year now, right? At the very start, I can remember, again, sitting in the RV bunker in Mississippi, as it were, listening to online webinars. Great analysis conducted by the leadership at Lifestyles Unlimited and then pushed out to the membership base for single-family investors, for multifamily lead investors, for multifamily passive investors. We all have a slightly different perspective, of course. And there were different webinars for each of us. And that feedback then got to us. And then in turn, the Lifestyles Unlimited leadership began to get feedback from the investors in our membership, from the lead investors, right? Members that are out there doing this business. What is happening? How is it developing? And that all goes back into that feedback system. And we continue to evolve our general discussion, our direction, our recommendations. You know, members are involved in the apartment associations. They're getting feedback there as well. So that all goes into that ecosystem and helps us make better decisions. We have a wonderful support network as part of that. And then finally, the Lifestyles model addresses risk by way of education. I'm going to put this under a whole separate subtitle here. Education addresses risk, right? If you just go willy-nilly into some deal, you don't know what you're doing. That's extremely risky. But if you are educated and you know the people that you are getting involved with are educated as well, you inherently are reducing your risk. If you know what you're doing and they know what they're doing, you stand a better chance, don't you? So let's talk about the lead investor now. I want to focus today on you as a passive investor getting into multifamily deals as a passive investor, but you want to understand that the lead investor, the syndicators at Lifestyles Unlimited, they are getting certified. They go through a very rigorous coursework to get that certification, and that tells you that they are well educated as it regards multifamily investing. And, you know, Del Walmsley, he hosts a radio show during the week at 11 a.m. Central Time. You can go to lifestylesunlimited.com, click on the radio tab, and there's a direct link to that program. That's at 11 Central Time. But commonly on Tuesdays, he'll interview investors, sometimes passive investors, sometimes lead investors, sometimes single-family investors. But when he has that passive investor on, he'll often ask the question, do you pick the jockey or do you pick the horse? Jockey being the lead investor, horse being that multi-deal itself. Most people focus on the jockey, on the lead. Right? Do I connect well? Do I like their business plan? Do I like the direction they're going? Of course, you want to as well understand, are they doing that deep value play that we talked about? Are they doing that yield play? Is it a hybrid somewhere in between? But most people start with that lead. But overall, we know that the lead investors that are certified, they've gone through this rigorous education. So that gets a big road bump out of the way. I get a lot of emails from people outside of the organization. I don't know who these people are. I don't know where they're coming from. I don't know what experience they have. You know, it's a little sketchy sometimes. And of course, we have our white paper at Lifestyles Unlimited, rules and suggested best practices for lead investors that we want them to follow. We expect them to adhere to, and that is good for me as a passive investor as well. And for you as a passive, there's a lot of education as well. I mentioned a slew of documents that you get as part of the process of becoming a passive investor in any particular deal. How do you read that private placement memorandum? How do you read that operating agreement? What's in that subscription agreement? What sort of red flags do I need to look for? Yellow flags? How much time do I need to spend? There's a lot of education that's going to help you shortcut that and get through those much quicker as you learn to become fluent in those documents. There's the multifamily passive certification. I've gone through that, 17 courses. A lot of information that dissects, for example, that PPM, how to read that. Looking at that analysis that the lead investor puts together, how to read those numbers. I went through a course taught recently by one of our national mentors for multifamily. And, I've gone through this before, went through it again, picked up new knowledge. We realized, holy cow, that's a great tip right there. So going through the education for you as the passive is tremendously important as well. As well, there's multifamily core education. You can do that as a passive. I did. Gets into a lot of what the lead's looking at, but you can do that as a passive. Makes you a little bit better rounded as well. When we come back from the break, I want to talk about how the Lifestyles team, and in particular our multifamily operational consultants, help us address risk. And then we're going to talk about as well that rental relief program. So stay tuned.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. This is Andy Webb. We are in our final segment today. If you've got any questions for me, send me an email. AskAndy@luinc.com. Again, AskAndy@luinc.com. And we're talking about multifamily investing as a passive investor. And what piqued my interest around this topic was a case study I was in attendance at this past Thursday. This was virtually, this was online. And there were a couple single family presenters. And when we got to the multifamily presenter, their deal, the numbers are great. We'll take a quick look at a couple of those later in this segment. But at the end, after they were done presenting, they went to attendees and were addressing questions that people in the audience had. And somebody asked, what's the risk you'll lose all your money? And I get it. It's a legitimate concern. You've worked hard to save your retirement savings, whatever you have in the bank, whatever it is. You don't want to lose it all. And as you get educated, you understand that the way we approach this at Lifestyles Unlimited, we have a vast ecosystem of very educated, very intelligent, very informed people that have been doing this for a long time, that are standing by our sides to help bring us up. The organization's been around for 30 plus years. And I'll tell you a little bit about some of the people that are in that organization that are there to help you. But because of that, because of the model that we follow, the types of properties that we are targeting, Class B and Class C, single family houses and apartments, workforce housing, we address risk tremendously. Our renter pool is much, much bigger because of the products, because of the unit types that we're taking down in the market. And what we're doing to those, best product, best price, we're fixing those up. We're turning those around and getting those on the market at a great rate and getting the best residents as a result of that. And those residents treat us well, by the way, during coronavirus. We'll talk about that here momentarily as well. But we address risk as well through not just the Lifestyles model, but through education. Right? The lead investors that are part of Lifestyles Unlimited are highly educated. They know what they are doing. And if they don't, guess who they go to? They have mentors that they can talk to. So part of the Lifestyles team addresses risk as well. That ecosystem that I mentioned earlier, where we've got that great feedback loop, information going from top to bottom, bottom to top, just circulating through the whole environment is extremely helpful. And as part of that ecosystem, this lead investor has a pool of other lead investors to reach out to as well. So we have the mentors, we have our broader group, our broader network as well, and we have multifamily operational consultants that are in each of the offices and nationally to help address how we're operating our business as well for the lead investor. That's tremendous. For example, one thing they do is if you feel you need it, you can have them come out, take a look at your property, and they'll do an operational audit, give you your findings, and you, the lead investor, can then fine tune that machine and get it running even better. Right? You don't just have to do that as the boat is sinking, but bring them out to really improve the operations even more so. And again, to go back to the education, for a passive investor, I find this is huge. It's comforting to know that lead investor is educated, but for me, it's comforting to know how that whole private placement memorandum process works, what those documents are, how to read them, know what questions to ask, how to analyze the deal, right, around the numbers. If you're like me, you're a type B personality, you want to understand the numbers. And as a result of going through the education as a passive investor, I have a much better handle on that. And there's ample extracurricular class time or class work online as well. So that's the education side. We talked about the model, and then that lifestyles team. Again, the mentors and the operational consultants are huge for our lead investors. And you as a passive, right? You'll sit down and talk with that mentor as well when you become a member. Hey, what's your direction? What's your plan? What's better for you? You know, we did that 8 years ago, went down the single family route, started to accumulate those houses, build that capital. And now we're at a point where we've shifted gears, and we've met with that multifamily mentor once again to say, hey, we're taking a new direction. What's the market look like? Here's what we're thinking. We're looking at small multifamily, right? On our own as an independent rental owner. That's something you can do as well. Lots of different ways to get there with Lifestyles Unlimited. So I want to now kind of shift gears just slightly and go back to something I mentioned in the first segment, which is Del Walmsley's Rules of Investing. I said, number one, to that listener, to that attendee's question, what if you lose it all? What are the chances? Well, never lose money. That's rule number one. And we do that, like I said, by, among other things, following this very specific model and buying right, buying below market, okay? Buy at a discount, both on single family and multifamily. Number one, never lose money. Number two, and I'm going to tie this into the presentation that the case study multifamily lead investors gave on Thursday. Number two, Dell's number two rule, it has to cash flow. If you're on the coast and you're buying for appreciation, you're doing it wrong. Just going to tell you now, you're doing it wrong. It needs to cash flow. Now, I will tell you, we're seeing a tremendous amount of appreciation here in Texas as well. It's almost behaving in some places of Texas like those coastal markets in terms of the appreciation that we've been seeing. So that icing on the cake of appreciation that we see, we've really been seeing a lot of that. But that is not why we buy. Number two rule, it has to cash flow. And when I look at this deal that the Central Texas members presented, they bought a 48-unit complex about an hour west of San Antonio in a smaller market there, what I would call a tertiary market. The investments that we've done are also in tertiary markets. I love those smaller markets. The cash-on-cash return to their passive investors, 11.5%. Good numbers. We're commonly seeing now maybe 6 to 8%, sometimes double digits, 10 here, 11.5%, just on the cash flow. Right? That's that cash-on-cash return that I'm getting in my pocket. That doesn't even speak to the whole equity capture. That's a big piece as well. And that takes me to rule number three. Number one, never lose money. Buy at a discount. Number two, it has to cash flow. 11.5% return to passives on this deal. Number three, you can't get rich slow. And in part, there's a couple of ideas here. Number one, for me as a single family investor, don't just sit on those things and pay down the debt till I'm debt free and do that debt free scream. That's not what we're doing. We're doing cash out refis. We're selling. We're taking that debt equity and putting it into these apartment deals, putting it into more single family deals, small multifamily, duplexes, tris, quads, that independent deal. The other thing is with the way apartments are valued is extremely tremendous. It's huge. You can really pull a couple of levers, drive up that cash flow. These businesses, they are businesses. This is different from single family. The multifamily is valued on the cash flow. And when you improve that marginally, you can see a massive return on the equity. And here, by way of example, this deal west of San Antonio, in 3 years, they've already done a cash out refi, returned a tremendous amount of cash to their members on top of that regular cash flow. But in 3 years, they have made a 160% return on their original investment. That's tremendous. That is huge. You cannot get rich slow, and that is not going slow. That 100% is doubling your money. Well, they're already at 160%. This is why I like passive deals. This is why I like the multifamily side of the equation. This is what we've been working towards over the years, and that's where we are now. It's where you can be too. Okay, again, you can learn more about Lifestyles Unlimited and the Financial Freedom Program. Get to that 2-day seminar that David Fisher teaches. Go check out financialfreedomlivestream.com. And again, the promo code for a massive discount there is SAVE BIG. Now, I want to finally shift gears and talk about COVID, where we're at. In this particular deal, by the way, this 48-unit west of San Antonio, this question came up as well. How's it looking? They said they've had, it's basically been a year now. They took this apartment complex down pre-pandemic. Okay, so they already owned it. We're operating it as we moved into the pandemic. During this entire year, they've had no evictions at all. That's a common question. People are worried about evictions. Are you getting paid? Not only have they not had any evictions at all, of those 48 units, only 2 units had a family or residents that were struggling in some way because of the pandemic. And these lead investors, they worked with them, worked out payment plans, got them back up and running, got them stabilized. Everyone's happy. In fact, they've gained longer-term tenants, longer-term residents. As a result of that, these two families have now gone on to renew their leases. They're happy. So good news there. If you are struggling, or if you do have a resident that is struggling and you are in Texas, there is a new program coming out. So I want to shift gears finally to that. You're going to want to look up TexasRentRelief.com. That's all written together, TexasRentRelief.com. This is a program that is coming online tomorrow, February 15th. Now, I don't know how President's Day will affect whether anyone's in the office there or not. It is a government organization, but kicks off tomorrow, February 15th. It's administered by the TDHCA, that is the Texas Department of Housing and Community Affairs. What's happened is, as part of the most recently passed coronavirus relief bill, Texas has received $1.3 billion in emergency rental assistance funds. This can go towards rent. This can go towards utility bills. Best place to go for you is to go to TexasRentRelief.com to learn more. You can also go look up Texas Department of Housing and Community Affairs. They comment on that as well. Who qualifies for this? Well, households have to have an income that is at or below 80% of the area median income as defined by that TDHCA. So figure out what that is. They have to have qualified for unemployment benefits or a test in writing that they have suffered in some way as a result of the pandemic. So you can read more if you go to TexasRentRelief.com. If you do have a resident that is struggling, you can apply on their behalf. They can apply. You can receive the funds directly. So big help there, I think. So, yeah, thank you for listening. You've been listening to the Lifestyles Unlimited Real Estate Investor Radio Show. And remember, it's not the money, it's the lifestyle. You have a good day.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.